Welcome to the Genus quarterly video. This is January 2020, and we're going to talk about the quarter ending December, but also the year, just because it's a year. And Wayne, I just want to say, tell me about 2019.
Well, 2019 was when everything was all good. All the good news came out effectively. In 2018, there was a lot of bad news. In 2019, a lot of the good news came through. The Fed changed their direction from where they were in 2018. The trade thing got kind of put to bed. So a lot of good news came out in 2019, which drove the market higher.
So when we entered 2019, actually it was summer 2018, we got defensive in the portfolios. We entered January 2019 relatively defensive in the portfolios. And I guess we were looking more at economic numbers, and the market was anticipating good things that really weren't in the numbers yet.
Yeah, well, we have different models that look at inflation, look at money supply, and interest rates, and they were pointing to a slowdown in Q4, which happened. It's happening, right. A global slowdown, and we're still kind of into it in this current quarter here. And the slowdown, frankly, wasn't as bad as expected.
Right.
Based on the signals we had, we thought it'd be worse, and we were concerned that there could be some accidents in Q4.
Right.
And actually, it was a positive surprise. The U.S. economy was stronger than anticipated. It's got a lot of mo, obviously, and that got us through this period. We thought there'd be a slowdown. That being said, looking forward, we think we're coming out of that valley, and things are looking better in 2020.
Yeah, and one of the big things was the Fed talking about quantitative tightening. And then it turned around, actually, they didn't announce it, but we know they were doing quantitative easing in the fall.
They're doing Q4, which is probably faster than Q3 right now. So they actually turned tail on that as well.
Right, and they didn't really advertise that at all.
Yeah.
So you got to watch the Fed pretty carefully.
Yeah, and the monetary base, and watch what they do, not so much what they say in this case.
Right. I guess it's markets always look at what they want to look at, and right now they're looking at all the good stuff. But I probably will always raise this for the rest of my career, but the deficit, the debt, the global debt of the global governments, and just the day of reckoning one day, given what that debt looks like relative to global GDP, is really where it normally is in a time of a crisis. And we're in a time of a 10-year expansion, not really the time when that ratio should be so problematic.
It is problematic, but it's a longer-term issue, and the market just can't focus on it.
Right.
And so right now it's looking at the Fed being on pause. We have QE4 effectively.
And Brexit having been done.
And Brexit having been done.
Whatever that means.
And we're into an election year, which is usually good for the markets as well. They're not going to put the brakes on into a presidential election.
Well, that's interesting because of this polarized world we live in, and right now, Bernie looks like he's the Democrat. Of course, that can change dramatically between now and the time. But if it is a very progressive, they call it progressive, i.e. very left-wing Democratic candidate versus Trump, surely the markets will be volatile in 2020.
Well, I think certain sectors will get hit. You'll probably see the healthcare sector get hit at least. There'll be probably more volatility because of that. But right now, I still would say that Joe Biden is the odds-on favorite. Looks like Bernie's got some mo. But there's going to be a battle in that party, and I think Joe is going to probably win, or maybe even Buttigieg could be is the dark horse on that. So I think at the end of the day, the market's not concerned about. If you look at the betting odds, it's still Trump is favored to win, given the momentum of the economy makes it like that. So there's a lot of good things. So the market's not going to worry about that too much right now.
Right. One thing I just wanted to talk about too in 2019, just this sector difference. Globally, stock markets around the world were up about 20% plus. Not a huge difference in the different parts of the world, but very different in different sectors within the stock market. So with the tech sector being up over 45%. So what do you think do you think that can continue into 2020?
No, I think in the leadership there was very narrow. They're the bigger players, the FANG type stocks were carrying all the mail and carrying the market forward. That can continue. The good news is there's a lot of stocks that still don't look that bad, that have lagged, that are smaller cap, that are value stocks. That are more economic sensitive, that can do well the next few years. So I think we can get more rotation here. I think maybe, right now the market's a bit overbought in terms of sentiment from where it's gone. It's discounted all this good news, and we're due for a bit of a correction. We still think through the course of this year the market will be higher, but you could just see a sideways market for a while as the market rotates into more economic sensitive names, as we get more visibility on the economy. And
Right.
We're looking at money supply, we're looking at purchasing manager index. It is turning, it looks stronger the next year, and the Fed's leaning into this, and so I think we're going to have a stronger growth next year, and
the Fed's on hold.
And the Fed's on hold until after election.
Which means not good news or bad news, but
Right.
probably good news because they've lowered rates so much.
Right.
Yeah. So tell me about our Genus new U.S. fixed income fund. We're going to put that into the clients' portfolios in about a month, about 10% to hold, and it's going to come out of the other fixed income products. Why is Genus doing that, and what can that do for our clients?
Well, it's just a way for our clients to get more exposure to U.S. dollar and more global plays on better spread investments, for example, in the high yield market in the U.S., corporate markets in the U.S., and often you get a higher premium there for holding these corporate names there, and as well as in getting involved in emerging market debt. So it gives our clients more diversification, more spectrum,
Right.
and more places to play. Given the fact that rates are so low in Canada, we have our 10-year is about 1.6.
Right.
We can go abroad. And if there's any issues around Alberta, this is insurance the way we see this. So we have a
Right.
place to play and protect our clients' money. We did it really for defensive purposes, but I think longer term clients, a lot of our clients go to the U.S. for
Yeah.
holidays. They want to have U.S. dollar exposure. So I think it's a good thing for our
I was
clients.
just going to say, some clients will love having their Hawaii or their Palm Springs or their Florida
Yeah.
liabilities
Yeah.
in U.S. dollars, so they don't have to worry about that exchange rate. So, if you want to learn about what that means for you, please call your portfolio manager. Just on another couple of things for clients, you probably noticed that we've gone online for your quarterly reports, but if you'd like to get them still mailed to you, no problem. Just give your portfolio manager a call and we'll mail them to you. And one more sort of housekeeping that I'm going to take this advantage of talking to everybody to just talk about. January 22nd is our annual What Happened Last Year, What Do We Think Will Happen Next Year seminar, but this year it will be a webinar. So if you want to participate or listen from home, that's an option. So again, just talk to your portfolio manager. Hopefully this will be mailed to, or emailed to you before January 22nd, so you can learn that. So Wayne, I think the low interest rates and low inflation is a big support for the market. The valuations of most of the market,
Right.
the value stocks are still very attractive. So despite the fact markets have been up over 20% last year, it feels like a good time to be in the market.
Yeah, well, last year the market was really driven by growth stocks.
Right, and
technology. A very narrow
Yeah.
sector of growth stocks. And so value is cheap right now. It's been beat up for the past 2 years. We have exposure to that space in our dividend strategy, for example. And as the economy starts getting a little stronger, you'll see investors get more confidence in the E and price earnings ratio in earnings and start moving back into value stocks. And so we think this could last for a couple of years.
Yeah, so I just heard something this morning I found so interesting because the world's puzzled over how do we get this full employment and no wage growth. And that's usually a sign of the economy coming to a close is,
Well, it's technology. Technology is having a big, first of all, we have Asia, we have China, we have a global manufacturing supply chain, but it's also technology. Amazon is dislocating retail, for example.
Right.
And you have Uber, and you have all these different things that are actually impacting cost structure.
Yeah, well, and I heard something that makes sense to me is the baby boomers are retiring and their jobs are being replaced by younger workers who have not 30 years or 40 years experience, but a much lower pay scale, even for the same job. So there's just not the pressure on the wages, which I think is a bit of a disconnect. Normally that would signal the end of the cycle.
It's a different world from where it was 20, 30
Right.
years ago.
So we've had a great year in the markets. It's a good year, been a great quarter even. I don't know, Wayne, should we talk at all about global things? I mean, Iran, such a tragedy for our Canadians and the world to have a passenger airline shot down, but is there any big influence on the global markets?
I think anything came out of that. I think this is going to go on for years. There's been a proxy war going on in the Middle East now for the past 10 years. It's going to keep going on, I believe. If there's anything that it could be a shock to the oil supply if they started impacting the flow of oil in the Strait of Hormuz or something like this.
Right.
That would be the big impact there, I'd say right now.
Right. Well, Wayne, thank you for the update on the year, and hope you can come or participate in our January 22nd webinar or seminar. We welcome your attendance too. So we'll talk to you again in April, and please call us if you have any questions.